Hello and welcome. Before we start, please subscribe to our YouTube channel for news and updates. Risk-off sentiment dominated last week with equities broadly lower. The S&P 500 declined, led by weakness in mega-cap stocks and the Nasdaq. Small caps traded lower but performed in line with the S&P 500, while low volatility and the equal weight S&P 500 outperformed, indicating the average stock fell less than the index. Defensive sectors outperformed, including healthcare, real estate, and consumer staples, while technology and consumer discretionary underperformed. International equities outperformed, with developed leading emerging. Bonds traded lower as Treasury yields drifted higher, and high yield outperformed investment grade. Commodities were steady, with oil and gold little changed, while the US dollar strengthened modestly. Volatility increased across asset classes, with the VIX and MOVE indices rising. Key takeaways: 1. U.S. retail sales rose plus 0.5% in July, with broad based gains and an upward revision to June. Auto sales led the gains, likely boosted by consumers accelerating electric vehicle purchases ahead of the September 30th tax credit phase out. Online shopping also saw strong gains, lifted by promotions such as Prime Day and Walmart deals, and spending on clothing, furniture, and sporting goods was strong. The core retail control group, which excludes volatile categories and feeds directly into GDP, rose plus 0.5% month over month and nearly plus 5% year over year, signaling strong underlying demand. Despite the broad strength, there were areas of weakness, including building materials, restaurants, and electronics. Implication: July retail sales show a solid start to Q3, with autos and online shopping driving growth. If momentum holds, the case for rate cuts weakens. However, any cracks in spending could bring them back into focus. 2. Industrial production fell by minus 0.1% in July after a plus 0.4% rise in June. Manufacturing was flat, while mining and utility output declined. Beneath the surface, durable goods production rose plus 0.3%, led by aerospace, electrical equipment, and autos. High-tech industries continued to shine with a plus 1.4% monthly increase, suggesting the AI capex cycle remains a powerful tailwind. August 15th, 2025 weekly note. Implication: July's report indicates industrial activity is stabilizing as producers navigate tariffs, trade negotiations, and an uncertain outlook. 3. U.S. housing starts rose over plus 5% for a second consecutive month in July. The strength came from multifamily starts, which jumped plus 11.6% to the highest level since May 2023, while single family rose plus 2.8%. In contrast, building permits fell minus 2.8%, hitting a 5-year low and signaling softness in the coming months. The data shows housing is caught between short-term rental-driven growth and structural headwinds, including high rates, rising costs, and weak builder confidence. Implication: July's housing data offers mixed signals. Activity has improved from recent lows, but permits remain soft. The combination suggests housing could remain a headwind in the second half of 2025. 4. The August 8th, 2025 weekly note discussed the soft Q2 GDP print and uncertain outlook. Economic activity cooled in Q2 due to tariffs and policy uncertainty, and our U.S. business cycle indicator slipped into contraction. However, the economy reaccelerated as the quarter progressed, and the momentum appears to have carried over into early Q3. The backdrop looks similar to earlier this year: steady consumer spending, sluggish manufacturing, and weakness in housing. Implication: on balance, the data points to an economic slowdown rather than a recession. 5. Investment grade credit spreads are the tightest since 1998. Several forces are driving spreads tighter: falling rate volatility, strong demand for quality yield, Fed rate cut expectations, and solid corporate fundamentals. Despite being tight, the index's effective yield is near 5%, so the all-in investment grade bond yields remain attractive even as the credit risk premium is thin. Implication: at 0.75%, investment grade bond spreads are rich versus history and offer limited compensation for downgrade, default, liquidity, and macro risk. This tightness aligns with a soft landing narrative, but leaves little room for error if economic growth weakens or inflation reaccelerates. Stay calm, stay invested, and let us know if we can help. Visit MRAadvisory.com to learn more and schedule a conversation with one of our advisors. Thank you for listening. For additional information, please visit our website